Series 1 bonds. Are they a good investment? Right now, the US government is literally paying you 5.27% just to lend them money. And most of you have no idea this exists. These are I bonds. They're boring. They're unsexy. But they might be the best place for part of your emergency fund right now. And I'm going to show you exactly how they work and whether they belong in your portfolio. Let's go. Part 1. What the hell is an I bond? An I bond is a savings bond issued by the US government. You give them money, they give you interest, it's that simple. But here's what makes them different from your boring savings account at Chase or Bank of America. I bonds have two interest rates that get added together. The first is a fixed rate. Right now, it's basically zero. I'm talking 0%. That part doesn't change for the life of the bond. The second is the variable rate. This one changes every 6 months and it's tied to inflation. Specifically, it's tied to the Consumer Price Index. This is where the magic happens. When inflation went crazy in 2022, I bonds were paying 9.62%. 9.62%. Your savings account was paying 0.01%. Your money was literally losing value sitting there. But I bond buyers? They were actually beating inflation. Right now, we're at 5.27%. It'll adjust again in November. The point is simple. You're getting a rate that moves with inflation. That's the entire reason to own these. To put this in perspective, a 3-year CD at Fidelity right now pays around 5.3%. A high-yield savings account, which used to be 4.5% to 5%, is dropping fast. An I bond? It adjusts twice a year. You're not getting left behind. Part 2. The catch. There's always a catch. And with I bonds, it's the liquidity. Here's the rule. You cannot touch this money for 1 year. After 1 year, you can cash out, but if you do, you lose the last 3 months of interest. So realistically, you need to lock it up for 18 months to not leave money on the table. And here's the bigger thing. I bonds have a minimum holding period of 30 years to get the full benefit. But most people don't hold them that long. You can hold them for 5 years, 10 years, 30 years, whatever. But the longer you hold them, the better the deal becomes. The real catch is this. This is not an investment for money you'll need soon. If you're saving for a car down payment in 6 months, I bonds are not your play. You'll get crushed by the early redemption penalty. But, and this is huge, if you have emergency fund money or money you're not going to touch for 2 to 3 years, I bonds are absolutely worth looking at compared to your standard savings account. Part 3. Should you buy them? Let's get practical. There are 3 questions you need to ask yourself. Question 1. Do you have an emergency fund already? You should have 3 to 6 months of expenses in liquid cash. If you don't, I bonds won't help you because you might need that money. Get the emergency fund first, put it in a high-yield savings account. Question 2. Do you have money sitting in a regular savings account at a brick-and-mortar bank making 0.01%? If yes, move it. Open an I bond account at Treasury Direct today. That's where you buy them. Not Robinhood. Not Fidelity. Treasury Direct. Question 3. Are you trying to beat the S&P 500 for wealth building? Then no. I bonds are not that. The stock market averages around 10% annually over time. Your Roth IRA invested in VU or SPY will crush I bonds long term. But here's the thing. I bonds are stable. They're inflation protected. They're not going to tank 30% in a market crash like happened in 2020. So here's how I think about it. I bonds are a place for money that should be boring. Money that's not going into your 401k, not going into your Roth IRA, not going into brokerage accounts. It's the middle ground between savings accounts and investments. Part 4. The real talk. In a perfect world, interest rates will keep dropping. When they do, bond rates will drop too. But that inflation protection? That's locked in. You're getting paid to wait out inflation. That's the deal. You can buy up to $10,000 per person per calendar year online. If you're married, that's $20,000. That's real money. Go to treasurydirect.gov right now. Set up an account. It takes 15 minutes. Start with $5,000 if you're skeptical. See how it works. Move your boring savings account money there and stop leaving returns on the table. This is the move that nobody talks about because it's not sexy. But boring wins. Boring wins with money every single time. If this helped you, hit that subscribe button. We break down real money moves every single week. Let's go.